Why don't you give us a little summary, Mr. High Self? Everybody step back.
Yeah, y'all ain't ready. You want the news? You want the hot takes? You in the right place. This corporation has acquired Red Seat Ventures. Jordan, what's happening, my man? How are you feeling today?
I'm good, man. Today is Friday, the last day of Black History Month, but we still rolling into Women's History Month. Excited to get into some news today, and just excited to be here, man. We got some good news. You're moving this week. Trying out a new neighborhood in Brooklyn, South Brooklyn. I'm moving to South Brooklyn in a couple months, so
Let's
give
go.
some people some updates. But yeah, everything's good. How you doing?
We're going to build the podcast set in Prospect Park. Hold up. Get that landscape.
The business of talent barbecue out there, bro.
Yeah, there we are. That's right. Awesome. No, I'm doing well, man, and welcome back, everybody. Thanks for tuning in. Another week, another Business of Talent podcast, where we break down how different trends and stories across media, talent, and entertainment are redefining how businesses are built and scaled. In today's episode, we're excited to do a bit of a different approach to news and digest and really focus on some interesting M&A and investment activity. There's been a handful of different either acquisitions or strategic investments that we really just want to kind of highlight that have happened over the course of the past couple of weeks that I think are really just good kind of signals if we really abstract a bit to identify what some of these different market moves mean from a longer term perspective and how can you play into some of these tailwinds or headwinds, depending on how you look at it as you're looking to grow your own business or career. So let's jump right into it. The first one, Carlysle, very big private equity company and fund, invests in Entertainment 360 as talent management M&A continues to heat up. If you're not aware, Entertainment 360 is a prominent talent and literary management company. They kind of have two core business lines. One is really focused on talent management. They represent different Hollywood actors, writers, directors, showrunners. They do 360 management, so this includes different endorsements, sponsorship, as well as other business development. They also do film and TV production. They work with a lot of the talent, both on roster as well as external partners in IP, to develop, package, and produce original films and TV. They're the team that produced Game of Thrones. I don't know if y'all about that life, but that is no small feat. Definitely kind of industry defining upscaling of IP, right? A book series that became a sensation in the world of scripted TV. The deal points weren't disclosed, but it is a minority investment. I think it's really interesting. The Entertainment 360 team spoke around some of the different reasons as to how they want to kind of deploy these funds. One interesting quote in that press release is that they want to expand our platform to continue delivering dynamic results for our clients in an ever-changing entertainment landscape. And I think if we take that a step further, we could probably they want to start expanding or investing in high-growth creator services, digital representation, influencer marketing, brand partnerships, also looking to explore growing content development, production opportunities for in-house talent. So I think with these funds, it can be tough when you're just living off of commissions as a management company. When you actually have a little bit more runway and some little piggy bank, you can start playing more offensive moves. You can start increasing staff to make these more longer-term offensive investments, better service talent, create bigger, more long-term value with the different talent. And overall, I think what's exciting is that this is just kind of seeing big PE funds and firms like Carlyle starting to invest more into talent management is really, really exciting from my perspective. What stands out to you, Jordan?
I mean, it's really, the first thing that I thought of is it's really hard to get investors for businesses that don't necessarily come packaged with IP. When I worked for a management company, it was a strategic move for the people at the company to decide to get into to get into the record industry and start a record label, because we knew we didn't have any IP as a management company, and we knew it's harder to get investors and to get bought out as a management company. So to see somebody like Carlyle, this like private equity industry that tries to make safe bets. I mean, when I think of private equity recently, for better or for worse, I think of these huge private equity firms buying up real estate in New York City and driving up prices around the country, it's mainly because they know it's a safe bet. So for them to make big bets into agencies like this, like a talent management agency, for it to be one of the first, it seems monumental. And we've seen this on smaller scales before. Obviously, there are very big talent agencies. It's management companies that represent some of the largest creators on the planet. But to get rounds of investment this big is sort of unheard of. I'm wondering if part of their model has changed to make up for it, though. They must have told Carlyle and people that want to get investments must tell these people, as an agency, we've negotiated IP with the creators in some way or another. Or else, if the creators leave, the agency doesn't exist. And I know you've dealt with this personally because you have an agency, a social media agency, and you know, cash is everything. Like what's coming into the door is everything because there's not as much IP to share with your clients.
Well, no, I think you bring up some great points, and I think both of us, having worked deeply and to some extent still deeply within the music industry, it's like management purely operating off a commission model is, like, from my perspective, now that I'm in this later state, like get this kind of mid stage of my career, if you will, is like not it. Like you hear these horror stories where it's like you have managers that were with the artist from the ground floor, took them to new heights, won a Grammy, platinum record, selling out 5,000, 10,000 cap rooms. After 10 years, the artist leaves them right as it's kind of getting to that like cash cow generating meaningful income stage.
Yeah.
The nature of common management contracts is really that you're just getting a percentage of revenue that's coming in the door. You're not actually getting long-term participation. If an artist is to sell their catalog down the line at the end of their career. So I think it's, if you don't actually have some deeper level of like IP participation, I think in last week's episode, we are starting to see how more creators are creating these like holding companies that bring together all of their different revenue lines, and investors and managers are able to take equity in that, which I think better aligns incentives long-term. I think it is also worth mentioning that a company I bet a large part of this investment is towards being able to double down on creating co-owned IP with the talent on their roster. And I think it's nice too that like these guys, beyond, as mentioned, they kind of have the two business lines. They have the talent management arm, but then they also have the like show and film and TV development. So in those instances, I presume they are actually getting some points on those different deals and the different kind of films and projects they're bringing to market. So I think lots
must be investing in them. They must be investing in them directly somehow, you know.
Investing in them, or if as a producer commonly too, if you're the one that is bringing the investors and the EP and the funders to the table, you're sourcing the director. Like producers, more often than not, when you see the producer slide on like in film credits, like those dudes have some level of participation on the actual like film itself. So I think, and now growing, as kind of mentioned in this press release, they want to grow content development and production opportunities. Like now they're actually starting to be more vertically integrated too, I presume. Right now they'll actually be able to build up their own internal content development and production staffing, such that you got to keep it in the family, as they say. That's get the IP and keep the circle small. No, we want to grow the circle too, bros.
I mean, have you thought about ways to get IP from the creators that you work with, or is that something that's like way down the line, or are you thinking about how they gain IP into things and helping them get to that point, or was it more so just helping their brands expand?
Yeah, it's a great question, and actually one of the biggest strategic priorities for this year as we think through the next frontier of Knox as an agency. Right now, I mean, we are very dialed in when it comes to all things like helping talent and brands grow and convert audiences online through like social media marketing, content creation, influencer partnerships, etc. But yeah, we are. And I think there's interesting opportunities by way of the rise of all these podcasts and how you can create revenue generating media IP and media assets, right? It's like we have access to the talent, all the different production resources, distribution resources. Hoping to be able to share some big news there in the coming months.
Yeah, maybe one of these news articles will be Knox gets $100 million investment from Carlisle.
Another post. We'll see.
Yeah.
All right. What's next?
Publicis Group announced its acquisition of BR Media Group, a leading influencer marketing company in Latin America with a network of over 500,000 creators, including 80% of the region's top influencers. Founded in 2012 and based in Brazil, BR Media Group serves more than 500 global and local clients, offering end-to-end influencer solutions and leveraging micro and nano influencers. This move aims to enhance Publicis' identity-driven influencer marketing capabilities in the rapidly growing Latin American market. The current leadership of BR Media Group will remain in place. Growing Latin America market. Interesting. According to the Rio Times, Publicis reported a 30.3% growth in its Latin American operations in 2024, highlighting the region's expanding market potential. The way this was written, this is like a pretty obvious move for them to do. I'm wondering what the preconditions were for this growth in Latin America. 500,000 creators, 80% of the region's top influencers. I mean, how do you even get that many that many creators and that many top traders under one roof like that in the first place? You get
great relationships with big brands that want to spend a lot of money. It's always interesting on the influencer marketing agency side because it's like a two-sided marketplace. You're effectively matchmaking brands with different creators. It's always going to be like the demand side being the buyers, the funds, the brand advertisers. If you're able to really like build momentum and relationships there, then it makes it that much easier to start getting influencers and potentially getting them to a point where they might even entertain signing some level of like exclusive deal just by way of the fact that they know they're going to have so much demand and revenue coming in through that partnership. I think what also gets interesting too is like Publicis is one of the world's biggest agency holding companies. Their market cap is 26 billion euros. I think they last year there was kind of massive headline when Publicis
You reminded me of that Jay-Z line where he says, "We getting euros, plural." You said you get like euros, bro.
Yeah,
not dollars, euros.
Like euros.
They're getting cash, bro.
Like international food and international currencies. You feel me? That's right, bro. You gotta have
my bad though, but I didn't continue.
But back to business. What's it called? Publicis last year acquired Influential, another influencer management company, for $500 million. This is one of like the kind of biggest breakout like influencer management agency acquisitions to date. I think it was obviously, that sticker price is absurd. Like that's a massive agency acquisition. I think it's even more interesting too. I think when it comes to like the multiples on different agencies, it tends to range, and I think there's different like multiples of EBITDA to determine the valuation of some sort of acquisition. Can range typically like 3 to 10, give or take. Bigger you are, faster you're growing, higher it'll be. If you have more tech, if you have some level of actual IP, that can also start to run it up further. Influential had a 15x EBITDA multiple for their valuation, which is pretty crazy. They were on the tails of like 50% year-over-year growth kind of going into that acquisition. But the reason I just bring this up is it's like Publicis, one of the biggest agency holding companies, is just realizing that this is like big brands and just global commerce is shifting towards influencers. So they are spending big money to stay relevant. I think this is even going to be interesting as we speak to one of the last things we'll talk about momentarily, which is around how Fox has acquired a podcast network. But it's like, whether it's the traditional agencies or traditional media, it's often either like buy or build, and they realize that they need to have some level of participation within this new paradigm of attention and distribution, which is shifting away from institutions and towards individuals and creators and talent. So I think oftentimes it's then easier too for them to buy than it is to build, because once you get to be such a big agency, there's kind of the diamonds in the rough that are able to have a strong culture of innovation. But oftentimes the bigger the company, the more kind of rigid they get, and really focusing on upholding their current model versus really trying to lean into innovate across new models. But by being able to deploy funds, very positive market signal, I think, both across the investment we spoke about with Entertainment 360, the management side, or here on the influencer marketing side. Just seeing funds and more traditional entities continue to participate in deeper ways is really exciting, and I think it's just still in early stages.
Does it not seem like all of this is happening like really fast? Like the fact that week over week we can be like, yeah, this company spent $100 million. Like the fact that this is happening so quickly in the beginning of 2025 is flabbergasting to me. I don't use that word often. That's how you know it's real.
My man is flabbergasted.
I'm flabbergasted right now about all this money heading into the creator economy, and I think this next one is a good one to end on, because it's the traditional media corporation. It's a traditional media corporation taking that into account and taking into account where the money's flowing. Why don't you give us a little summary, Mr. High-Sell? Everybody step back.
Yeah, y'all ain't ready. You want the news? You want the hot takes? You in the right place.
Everybody shut the fuck up.
Yeah. Fox Corporation has acquired Red Seat Ventures, a digital media company known for partnering with prominent media personalities such as Megyn Kelly and Tucker Carlson. Red Seat Ventures has over 200 million monthly views. It's a top 10 podcast network. It's kind of one of the top 10 podcast networks in the U.S. in terms of audience reach. 36-person team. Fox making this acquisition is really interesting. Strategic move that it aims to really enhance Fox's position in the growing podcast market and attract younger audiences. Red Seat Ventures will operate independently with Fox's Tubi Media Group, maintaining its existing operations and client relationships. But yeah, man, I mean, this is, I think this is what is needed in order to stay relevant with younger demographics.
I mean, is it giving like, you know, because Fox, when I think of Fox, I think of like generally an older demographic. And I'm wondering if this is also a ploy for them to maintain relevance. Like, let's just throw money at it and bring one of these companies in to help us expand our presence in this field that we may not know much about. Because when we think about traditional media, like Fox News is one of the most traditional media companies in the world. Another random thing is, if this company partners with Tucker Carlson and Fox fired Tucker Carlson, that's kind of a crazy. They playing chess over here with Tucker Carlson. They said, all right, leave that. We just going to buy the company you partner with. Whatever, bro. Now what you going to do, bro? Now we're all Fox. That's just a crazy thing I wanted to slip in there. I think Megyn Kelly might have left Fox too. So, yeah. It's kind of shiesty. But yo, things like this are particularly noteworthy, because the last type of companies that are going to get into this new space are the companies that feel threatened by it. And I'm sure at some point Fox felt threatened by the podcasting space and the new media space, and now know that they just need to be a part of it. Like, has anybody seen Fox TikTok? I'm sure they probably got some 23-year-old on Fox TikTok like going ham right now, because they're like, we got to do what the kids are doing. And I feel like this is sort of in addition to that. But if Fox is okay with it and spending money towards it, they must not see it as a threat anymore, but an asset. But what do you think, Sam?
Well, I think it needs to become an asset. Otherwise, it is a threat. I mean, when you're at the level of Fox.
Bars.
Yeah, I mean, I think that there are shifts in different consumption patterns. I think it's oftentimes driven by younger generations. Even just looking like the kind of adoption of social media, largely innovated by Facebook, and even MySpace. I mean, Facebook exclusively started at colleges. Now it's really our parents that are the only people using Facebook. I think TikTok, Musical.ly, short-form social video platform, that had this kind of discovery mechanism that was kind of more interest graph and an interest-based algorithm versus a true-to-form like social algorithm. Mm-hmm. So both on the kind of algorithm side as well as on the actual like adoption and growth of like short-form social video as a medium side, similarly started with the younger generation. Now is kind of like a staple across a lot of different social media platforms. So I think consumption patterns that are being disrupted by technological innovation are going to be adopted and spearheaded by more digitally native audiences. Over time, they age up. Beyond that, I think there's two factors. One, this is a play to maintain their relevance and continue to reach and maintain their level of scale by making sure that they're operating where younger audiences spend their time consuming content. And then similarly, I think it's, just kind of the shifting role of what a traditional media company looks like in today's day and age. Even older people are listening to more and more podcasts. More and more people are getting their news and television through streaming and YouTube TV and watching the Fox YouTube channel and the Fox YouTube series. I think it's very exciting to see. I think we'll see more and more of this. I think it's even often better terms and better upside from like a creator perspective, which I think is another kind of model that's being disrupted here. Like if you're a television host and personality, you could be the breakout and for Fox or CNBC, ABC, whatever, have like hit that pinnacle, right? Tonight Show, Jimmy Fallon, right? Like once you get to those points, it's great, but that's definitely the fringe case. I think the average television personality is, you're getting raises here and there. You're not getting as much participation in the actual revenue that you're generating off of your series. And now that you don't necessarily need to rely on the distribution of a Fox or of a traditional media outlet, and you can just build it yourself across your own kind of new media podcast network or your own social channels, means that you can have more revenue participation and more upside in the value that you're actually creating. So I think there's kind of like how Fox is trying to make sure they're still reaching audiences at scale, but then you also have this kind of more like creator-friendly approach. And the last thing I'll say here too is I feel like you actually have this like positive competitive force where you have companies that are competing to create the best terms for creators, because they know that where creators go, attention follows. So if they're able to create a network that's going to have the best deal structure for that talent or for that creator, they're more likely to get that creator. So that now is a very productive capitalist force that sometimes might not be as productive or beneficial to individuals and creators.
Do you think that we could see like a Fox News, a CNBC, like pay a podcaster on their network more than they would, Sunday night live with ... like an actual host of a TV show? Do you think we could see the creator economy get to the point where the people that are creating async content, episodic content, are getting paid more than the people who do this live content that we're used to?
I think that's happening. Travis Kelce, $100 million podcast deal.
No, but why did
Trevor Noah? Why Trevor Noah's fucking doing a Spotify is doing a podcast? He's not on
right.
On
but
TV
the difference
anymore.
is those people are homegrown. I'm talking about CNBC has a podcaster that's doing news style segments and getting paid more than a main anchor. You know what I mean?
Yeah, potentially. I mean, we'll see.
Like that's kind of what if Fox acquired Red Seat Ventures, I'm wondering how hands-on they're going to be with talent curation and what those deals will look like, Yeah.
I mean, I'd love to see it, and I think I wouldn't be surprised if you're seeing a lot of, even when it comes to like editorial and like written content. I mean, you're people that used to were career writers for the New York Times for 20, 30 years are now like building a Substack newsletter. Mm-hmm. That is the market. That is, from a recruiting perspective, what traditional media is competing against. They're going to have to innovate on their comp packages and deal structures with talent. So, I could see and hopeful we see some innovation. I mean, I think even if you look in the music industry and as another interesting kind of like example or reference here, you've got, there at times still can be predatory deals, but generally speaking, I feel like there's been a bit of an evolution in the kind of artist market becoming a bit more educated and being able to create slightly more favorable deal terms, creating more models for independence. I think we'll probably see some level of similar evolution when it comes to those kind of like talent and TV personality deal structures. So, but that's what we got for y'all this week. There's a little bit of news, a little bit of digesting, Digest that alongside your international currencies, a little side of euro. But appreciate y'all for tuning in. I think next week we're excited. We're going to be doing a bit of a deep dive into talent-led CPG brands. Obviously, there's been no shortage of different talent-led CPG brands. Lil Yachty just announced Yacht Water, kind of a ready-to-drink tequila seltzer beverage. I mean, you got Mr. Beast.
Seltzer.
Yes, yeah. That's a tease. We'll dive deeper into that next week. But appreciate y'all tuning in. This is family. We're an extended digital family. So
yeah. Talk to y'all soon.
All right, peace.